All right, today we're diving into a real head scratcher. We've got a tech company that, on paper, looks like an absolute winner. But its stock price? Well, that's a whole different story. Let's get into it. So, picture this. You've got this brilliant AI company, okay? Their financials are incredible. But the stock? It's telling a completely different and kind of scary story. So, yeah, the big question is why? To really get to the bottom of this paradox, we've got to start with the company at the heart of it all. Let's talk about Elastic Envy. And this right here, this is the whole puzzle laid out for you. On one side, you've got the company story. Innovative search AI, a massive 75.6% profit margin, and a cool $1.4 billion in cash. I mean, that's fantastic, right? But then you look at the other side, the stock story, and it's a horror show. We're talking 52-week lows, a strong sell rating, and it's down 45% in just a year. You can see why this is so confusing. So, what does Elastic actually do? Well, the easiest way to think about it is like this. They're basically the private Google for huge corporations. They build the super powerful search tools that let these giant organizations dig through their own mountains of data to find exactly what they need instantly. And it's not like they're just sitting still. I mean, look at this timeline. Their tech is constantly getting better. In just a few months, they launched a GPU inference service, they snapped up another AI company called Gina AI, and they rolled out an agent builder. That kind of speed, that constant innovation, that's exactly why their financials look so darn good. Okay, let's talk numbers, starting with profitability. A 75.6% gross profit margin. That is seriously, seriously healthy. Think about it this way. For every dollar that comes in the door, they're keeping more than 75 cents. That's money they can use for everything. R&D, paying the bills, and, actually making a profit. And all that profit, it's allowed them to build up what's basically a financial fortress. Check this out. They're sitting on a massive 1.4 times billion dollars in cash. Compare that to their debt, which is just under 0.6 billion. So, yeah, this is not some company that's struggling to make ends meet. They have a war chest. And it's not just us saying the company looks good. The pros on Wall Street, they're bullish too. The average analyst thinks the stock should be trading up around $105 a share. That's a huge leap from where it is right now, which, of course, brings us right back to that big, glaring question. Why isn't it? Because when you turn away from the company's books and look at the stock market, well, the story it's telling is completely different. And honestly, it's kind of terrifying. Let's dive into the stock's performance. Okay, brace yourself. A 45, almost 46% loss in